Yeah, so that's really good, Tyler.
If I could just add one thing,
Yeah.
to a certain degree, this is almost enlightened self-interest because think about it from this vantage point, and I think everybody on the call, everybody listening, has probably remembered someone telling them at some point, treat the janitor the same way you treat the CEO.
Mm.
And the thought process there is there's a morality factor, right? Do the right thing, just be a good person. But the other side is you just never know where that janitor is going to end up. For
Yeah.
example, like one of the first deals I did in commercial real estate early on in my practice was I did a like 1,500 square foot lease for an office. And I didn't really do much leasing. Most of the stuff I did was sales. And they weren't huge deals, but they weren't small deals. And this was really probably not worth my time. But thinking back to it, this individual turned out to be someone who I did many deals with
Mm.
thereafter. He grew as an investor and he actually invested many hundreds of thousands of dollars later in my syndication deals. And so I never
Love
would
it.
have expected that would have happened. But I think it's enlightened self-interest to focus on everybody as there's a possibility here. And like you could almost boil it down to say there's an enlightened self-interest to where, yes, you're doing the right thing, but also you never know who anybody who's going to turn out to be.
That's yeah, so true. So good. It's great example of the importance of yeah, playing the long-term game. Let's talk about partnership. I know that in these deals, it's common that we will partner with others on a specific deal. We'll co-in, co-GP with them. But in your case, you're starting this business with an actual business partner. Walk us through what have you decided that you want to take on an actual business partner and not just a deal partner. Yeah.
I'm very thankful that I started from day one with a partner because I cannot imagine like the weight of responsibility all falling on my shoulders, whether it's developing the team, overseeing the systems of the team, overseeing operations when it comes to asset management, capital expenditure programs, acquisitions, equity raising, legal management. The list goes on and on. For any business, this is certainly the case. And I admire founders who can come out of the ground and just really handle all of those responsibilities. But I think that there's a lot of value in partnership, especially from day one, and being able to shoulder responsibilities, even make decisions. At the end of the day, sometimes having a sounding board to make tough decisions or even day-to-day decisions that can have a variety of pros and cons can be extremely valuable. So like for me, like I know we've had this conversation quite frequently over the past even like year is, man, I'm so glad that we have each other as partners to be able to lean on each other and like just leverage each other. And I just think that there's such more of an exponential growth pattern if you can find the right partner. And it really does come down to complementary skill sets. And if you're all doing the same thing, or if you're just really doing the same sort of activities and have a similar skill set, then it may not be ideal. But if you have the same sort of common values, North Star, but complementary skills and different roles and responsibilities that are clear, it can be super valuable. So that's my thought process on partners.
I see. Okay, very good. And what role do you play versus what role does your partner play in the business?
Yeah, so we are both visionaries and integrators. So from a high level like business ownership perspective, we play a little bit of a dynamic subordination in terms of when the moment calls for visionary expertise or integration. But when it comes to actual real estate application, I focus on equity and strategic partnerships and marketing of the firm. And my partner focuses on asset management, acquisitions, and kind of deal flow and so forth. So there's a little bit of kind of a role and responsibility difference, but we both do play part in each of those functions.
It makes a lot of sense. Yeah, that's a very common setup. I mentioned Paul Hutchison earlier. Same thing with him and John Pennington. John Pennington handles all of the operations, the acquisition, the asset management stuff, and then Paul was out there handling all of the capital raising, whether it's equity, debt, and yeah. So that seems to be a really good like dynamics of a partnership in our business for sure. That's really good. And then yeah, so what have you guys out of all the different asset class you can choose, what had you choose multifamily?
Multifamily was really the asset class that we had the most experience in, and we understood it to the highest degree. We do have a vision to where at some point we will expand sort of our asset classes, one of which we're looking at closely for the next few years, really more than anything is industrial. But multifamily is really the kind of asset class that we have the most relationships in, we have the most expertise in, we understand the nuances so that we can protect investor capital. And we have experience and we have a successful track record within multifamily. But ultimately, it is also an asset class that I'm sure many of the listeners and folks that have attended the party today would agree is that you can understand sort of the risk profile when it comes to, look, at the end of the day, our philosophy as human beings, we need three things. We need food, we need water, and we need shelter. And multifamily real estate provides shelter. And ultimately, yes, there are risk factors in the marketplace that I think we're all interacting with today, more importantly than we have perhaps in the last few years, that really help us really understand even further the ups and the downs of this asset class. But ultimately, shelter is always going to be in demand. So you have to think about that in terms of like how that compares to like office real estate, for example. Office is obviously going through a transformation. And so we just understand the dynamics of the asset class, and we're experts in the asset class, and we're staying in our lane until we have the capacity, breadth, and partnerships to be able to expand outside of the asset class as well.
I see. And then why Midwest and Southeast? I'm curious about that because it's two somewhat different markets.
Yeah, no doubt. And to be specific, we are focused on Kentucky, Indiana, Tennessee, and Ohio. Okay. And so we're based in Louisville, Kentucky, so right in the middle of all of our markets. So we're very hands-on when it comes to our investments. We have a significant relationship base within our markets, but also our markets are somewhat counter-cyclical over the last couple of years. Indianapolis, Louisville, Kentucky, Columbus, Ohio have been markets that have been top performing markets in the country in terms of rent growth. And they haven't been as crazy of like population growth and job growth in comparison to some other Sunbelt markets. But I think the pricing makes a lot more sense, and you're not having the level of new supply in these markets, which is continuing to put upward pressure on rental rates and so forth. But we are still seeing continued progression. So we're seeing like a slow and steady sort of marketplace in our markets for the most part, a lot of stability in comparison to some other markets where you may see more boom or bust, but that's where we're focused on. And we're very long-term focused in how we're doing this. We're not looking to play the speculative game. And for the most part, our markets are not speculative. You're looking at positive leverage. You're looking at replacement cost, acquiring assets below replacement costs and so forth. So that's really the focus on our markets. And when I say Southeast, it depends on how you look at it. Kentucky in some places is Southeast, in other places is Midwest. Nashville, Tennessee obviously is a little bit of an outlier in some of the ways that I described the components of some of the other markets that we're focused on. But anyway, that's some of the thought process behind our markets.
A lot of operators get deals that have challenges with, especially deals that they acquire in 2021 and 2022. How have you been navigating since the interest rate hike started? And do you have deals that have been challenging for you?
Yeah, I think the last couple of years have been certainly challenging for most investors in the market. And if you made any investments, to your point, in 21 or 22, and depending on the way that you finance those deals, you're probably running into some covenants that are needing to be discussed or worked out with your lender, and or you've got issues that need to be addressed. Fortunately, we've been very patient throughout the past few years, and we have recognized the level of, how do I describe this, irrational exuberance that was being exhibited across the marketplace, especially in 20 and 21, and really the first half of 22. So we were very patient. And frankly, if I would have looked back today to day one in 2020 and said that we have grown to the rate that we have, I would have been surprised, to be honest with you. I would have thought that we would have grown faster. But I'm proud of the fact that we've been very prudent, and we've been focused on deals that have made sense, deals that are acquired well below replacement costs, even after value add and so forth. All of our deals are doing well, but that we've definitely run into issues from like inflation, for example. Payroll has been a big issue that has impacted NOI. Insurance has impacted NOI. Tax rates have gone up. I think everybody is probably dealing with these issues. And of course, interest rates are a big deal. So when you're resetting debt on deals that you acquired 3 years ago, you've got changes that need to be made. So we have a deal right now that we're going through a refinance on that we would have expected to sell this year, that we acquired in 21, but we're looking to do a HUD refinance. So it's a much longer term hold as a result of the change in the capital markets. And that refinance is obviously setting out the hold period much more significantly. But those are a few things that we've been working through the past few years. And it certainly has been a challenging operating environment as well. And I think it has heightened the focus to be able to execute on your business plan and not just ride out cap rate compression, which is not something that we would expect to be a normal condition of a long-term investment market. It's probably a good reset for everybody, but certainly has required everybody to double down their focus.